So the next slide here is on convertible notes. One of the things that is important to understand is a convertible note really is debt. There's a maturity date, and there's usually an interest rate. It is debt. It goes on the books as debt, but it's not intended to ever actually be repaid. The whole point of it is to convert into equity at some point later. And so one of the big benefits to convertible securities in general is that you don't have to negotiate what the current value of the company is, which can really kind of help shortcut a lot of discussion and negotiation. Because especially at the earliest stages, like we said, we don't really know what the company's worth. It's really just a negotiation over a number. So convertible notes convert, obviously. And they'll either convert on what's called a qualified financing, which is usually defined in the note itself as a financing of a certain amount or more. They might convert at the option of the investors on some kind of financing that's not a qualified financing, and there might also be a conversion option in there at maturity if the company has not raised money prior to that date. So notes will convert on either a discount or a cap. A discount is pretty simple to understand. It's basically a discount on whatever the price per share is in the next preferred stock round. And a cap is essentially a maximum limit ceiling on the value of the company that will be used to determine the conversion price for those notes. So it could be, that's really to protect the note investors from you going out as the founder to someone who doesn't know how to value a company and put some ridiculous valuation on it that greatly reduces the amount that those note holders are able to get for the investment that they made. So what happens at maturity? There's really four possibilities. One is the notes will convert before then, or they might convert at maturity. Two is the maturity date might get pushed out. Three is the company might be done, and that might be the end of it. Four is the notes technically could be repaid, but I think I may have seen convertible notes repaid once. It's just not normal. The typical documents for convertible notes is much less than a preferred stock deal. There's a note purchase agreement, there's a convertible promissory note, and that's basically it. I find them to be the simplest of the three types of transactions, but they're definitely less costly in terms of money and time than a preferred stock deal, but they usually take a little bit longer and cost a little bit more than safes, which is what we're going to talk about next. So moving to that slide, again, a safe is, sorry, go ahead.
Yeah, real quick, we have a few questions coming in, and I think this question is actually going to be relevant also for safes. Talking about, someone's asking about what's a typical discount. I know from the safes that we've done with our investors and stuff, it seems like most industry standards is around 20% discount. Is that what you've seen as well? And what do you typically see in rounds?
Yeah, I would say if you're asking for just a general percentage, 20% is pretty typical. It kind of depends on how long it's intended to be outstanding. So if the maturity date is like 30 months out or something, it might be on the higher end of a discount. If it's only intended to be out there for 6 months, it might be lower. And then I've also seen notes that will sort of change the discount depending on how long it goes. And that's just to really compensate those investors for coming in significantly earlier.
Gotcha. Okay, great. There's a couple other questions. Another one we got by Jim. Do I need an attorney before I start doing pitches to angel groups? I definitely recommend to other entrepreneurs that they do have an attorney. There's a lot, and this is one of the reasons why I wanted to start working with you guys and everything on this stuff too, is because there's so much like digital law stuff now that you can go on and get an LLC or whatever and set up your company online, which is okay if you just need, like, if you're just trying to do a very simple LLC and you're not raising money and building a real company and whatever else. And those are great for some things. And if you don't have a budget, whatever. But most of the time, if you're building a startup, tech company, any type of growth company where you plan on hiring people, raising money, all of that, you need a lawyer so that you can email, talk to, knows your business, knows you, and you can contact whenever, and they understand where you're at, what you're doing, and can help you on that. If you do it online or you don't have that point of contact, it's going to be really hard, and you're going to be scrambling around when these things come into fruition, right? So I don't know what's your take on, whether people should really get lawyers before they start really doing pitches and stuff like that, but I'd love to hear your thoughts on it too.
Yeah, well, thank you for making my sales pitch for me, Michael.
Of course.
No, but in reality, I mean, if you've done it before and you kind of know what you need to have, you probably can go ahead and start kind of setting meetings up. But I would definitely suggest you talk to an attorney that works in these types of transactions as early as possible.
Yeah.
Especially if you've never done it before, you definitely should do that. Absolutely. Just because you're not going to know what you're walking into. There's a ton of information and good information out there on the internet and in books and stuff. But if I was a founder who was trying to go pitch in front of an investor, I would certainly want to make sure I have my ducks in a row and, put the best foot forward, first impression, all that kind of stuff.
Yeah, exactly. Okay, we have another quick question here. This is kind of pertaining to some of the valuation stuff that you were mentioning, the 409A evaluations. I know we sent the National Venture Capital Association link. Do they have any good resources on that, or are there any other resources that you would recommend for people trying to figure out how do they value their company right at the early stages?
Sure. The best one I know of is called PitchBook. And it's a subscription service, but I think you can get I think they release their, I don't know if they're quarterly, I don't remember, they're not monthly, but they're either quarterly, they might even be just annually, but they release certain reports with statistics and stuff that I find to be really, really good. The subscription is really expensive, so it depends on what you really need it for, but that is definitely good information. Yeah,
I know Carta is good as well. Carta.com. They have some cap table management stuff. Gust Launch is good as well. And there's a lot of other resources. I know some of the banks are doing this stuff too. First Republic Bank, Silicon Valley Bank, the banks that are more geared towards startups and stuff are helping with this sort of thing as well. So you can check those out as well. And then I don't know if you're planning to get into this later or not, but we have someone here asking about warrants as well. It's kind of like a type of a note in some senses. But I didn't know if you wanted to touch on that real quick, or if you're seeing any of that in the market now.
Yeah, we don't really see warrants all that much. I don't have anything in this deck about warrants. But typically, warrants they're kind of like an option to purchase a share. But where you used to see them a lot was before whoever it was came up with convertible notes. You used to see investors actually making a kind of standard loan to a company and then also getting warrants. And that kind of got combined into what is now a convertible note. But we really don't see warrants all that often, unless, I have seen them in situations where companies are actually getting bank loans, where, the bank might be a recipient of warrants, or maybe some kind of one-off situation where a service provider is getting some kind of equity. It might be done in warrants for some reason. But it's typically like a sweetener to a loan, or it's it's kind of like a quasi, compensation tool.
Yeah. Okay, great. And then real quick before we move on, we got one more that's relevant. Jake is asking about what happens to convertible notes if your business fails or isn't profitable.
Yeah, so it's very, very unusual that they carry like a personal guarantee or anything. And it's also pretty unusual that they would be secured. Although I have seen that sometimes where it's secured by some kind of asset that the company has. So in 95 or 99% of the cases, I mean, if the company fails, the investors are out their money. Everybody loses in that case. But as a debt instrument, whatever value there is to the company, if it fails, they would be ahead of the common stockholders because it's debt.
Right.
But yeah, if the company fails, typically the investors are just out their money and everybody kind of loses.
Yeah. Okay. Great.